When you're deciding between using a personal loan or a credit card, it's important to understand the key differences. Each has its advantages, but the right choice really depends on what you're using it for. Let's break it down. So, what exactly are they? A personal loan is a lump sum of money you borrow from a bank or online lender. You get the full amount up front, and then you pay it back in fixed monthly installments over a set period, usually between 2 and 7 years. On the other hand, a credit card is a revolving line of credit. This means you can borrow money up to a certain limit, and you can keep using it as long as you stay within your credit limit. If you don't pay the full balance by the due date, interest gets charged on what's left. When does a personal loan make sense? If you're trying to consolidate high-interest debt, like credit card balances, a personal loan might be the way to go. Personal loans typically come with lower interest rates, which can save you money in the long run. They're also great for larger one-time expenses like medical bills, home repairs, or weddings. One of the biggest benefits here is that you get fixed monthly payments, which means you know exactly what you'll be paying every month and when it'll be paid off. If you're looking for a clear, structured repayment plan, this is a good option. When should you choose a credit card? Credit cards are perfect for smaller, short-term expenses that you know you can pay off quickly. If you pay off your balance in full each month, you can avoid paying any interest at all. Another reason to choose a credit card is for flexibility. You can borrow up to your limit whenever you need, and if your financial situation changes, you can always adjust how much you're paying month to month. Plus, many credit cards offer rewards like cashback, points, or travel perks, which is a nice bonus if you use the card wisely. So what are the pros and cons of each? With a personal loan, the main advantages are lower interest rates and predictable payments. You know exactly how much you'll pay each month, and there's no temptation to keep borrowing more once the loan is disbursed. However, you may face fees like origination fees or penalties if you pay off the loan early. Credit cards, on the other hand, offer great flexibility and rewards, but they come with much higher interest rates if you carry a balance. Plus, the temptation to overspend is real, and if you're not careful, that balance can quickly get out of control. What should you consider before making a decision? Before you choose, take a look at the interest rates. Personal loans often have lower rates, ranging from about 5% to 12%, while credit cards can be anywhere from 15% to 25% if you don't pay off the balance right away. Also, think about how much flexibility you need. A personal loan is more rigid, but it's also more predictable. Credit cards let you borrow as needed, but you might end up paying much more in interest if you're not careful. And don't forget about your credit score. A personal loan, if you make payments on time, can actually improve your credit score. On the flip side, carrying a high balance on your credit card can hurt it. When should you avoid both? If you're not able to repay the loan or credit card debt on time, it might be better to avoid both options. Instead, consider alternatives like saving up, borrowing from family, or looking into 0% APR promotional credit cards that allow you to pay over time with no interest for a certain period. The bottom line, if you need a large one-time amount and prefer predictable payments, a personal loan might be your best bet. But if you need more flexibility, want to earn rewards, and can pay off your balance quickly, a credit card could be the right choice. Ultimately, it all comes down to your financial situation and what works best for your needs. Just make sure to carefully compare the terms, understand how you'll repay the debt, and choose the option that will benefit you the most.